Welcome back, everyone, to the Deep Dive. Today, we're taking a deep dive into asymmetric investing. This is a strategy that could revolutionize how you think about risk and reward in the market.
Very excited to be here.
It's all about finding those unique investment opportunities where the potential for profit far outweighs the risk involved. I'm excited to break this all down with our expert today. Let's just start with the fundamentals. What really makes an investment asymmetric? Like, what key elements should we be on the lookout for?
Yeah, so asymmetric investing is it's a philosophy that seeks to exploit situations where the potential rewards significantly outweigh the inherent risks. It's not about eliminating risk altogether. You can't really do that in the investment world. It's more about strategically managing and mitigating risk while maximizing the potential upside.
Right. You make a great point. It's about tilting the scales in your favor, so to speak.
Yeah.
So what are the hallmarks of such an investment?
Yeah, there are several key characteristics we can use to identify asymmetric opportunities. First, and perhaps most crucial, is the concept of limited downside risk. This entails implementing safeguards to protect your investment from substantial losses. Things like stop-loss orders, where you automatically sell a security if it drops below a predetermined price, and diversification, spreading your investments across different asset classes, play a significant role in limiting downside risk.
So it's like having a safety net to cushion the fall should things not go as planned.
That's a great analogy. The second hallmark is the potential for significant upside. We're looking for investments with the inherent capability to generate substantial returns relative to the initial capital outlay. Think of it as aiming for a scenario where your gains could potentially multiply significantly under favorable conditions.
So it's not just about making a decent profit. It's about aiming for those home runs, those investments that could truly skyrocket in value.
You got it. And this leads us to the third characteristic, non-linear payoffs. This is a crucial concept that sets asymmetric investing apart from traditional, more linear approaches. In a typical investment scenario, the risk and reward are often directly proportional. You invest a certain amount and expect a corresponding return. However, with asymmetric investing, the payoff structure is different. It's more akin to an option-like profile where gains can accelerate rapidly under the right circumstances.
Can you elaborate on that? How does this option-like profile differ from a traditional linear payoff?
Think of it this way. In a traditional linear payoff, your potential profit increases steadily as the value of your investment rises. It's a straight-line relationship. With an option-like payoff, however, your potential profit can increase exponentially once a certain threshold is crossed. It's like a sudden surge in value, a point where your gains start to multiply rapidly. This non-linearity is what allows for those outsized returns we associate with asymmetric investing.
I see. So it's not just a gradual climb. It's more like a hockey stick curve where the gains really take off at a certain point.
That's a good visualization. The final and equally important characteristic of asymmetric investing is selective positioning. It's not just about finding any investment. It's about meticulously choosing those that align with the asymmetric profile we've discussed. It requires actively seeking out opportunities with high reward potential while simultaneously avoiding or hedging against those with limited upside or high risk.
It sounds like this approach necessitates a significant amount of research and due diligence. You need to understand the intricacies of the market and identify those hidden gems with the potential for these asymmetric returns.
It certainly does. It's not a passive strategy by any means. It demands active involvement, thorough analysis, and a keen eye for spotting those opportunities where the potential rewards justify the inherent risks.
So we've established the key characteristics of an asymmetric investment, but how does one actually apply these principles in the real world, particularly in the dynamic and often unpredictable stock market?
That's a great question, and that's what we'll be delving into next. When it comes to the stock market, there are specific strategies designed to help you achieve those asymmetric returns. We've identified 4 key characteristics of asymmetric investing: limited downside risk, potential for significant upside, nonlinear payoffs, and selective positioning. These principles serve as our guiding lights as we navigate the complexities of the market in search of those elusive opportunities where the potential rewards can far outweigh the risks involved. So now that we've kind of laid that groundwork and we have an understanding of the core principles of asymmetric investing, let's see how they can be applied in the stock market.
Yeah, this is where the rubber meets the road. Let's talk strategies. What are some practical ways to pursue asymmetric returns in the world of stocks?
One of the most powerful tools in the asymmetric investor's arsenal is options. Options contracts provide a unique way to leverage your capital, and potentially generate outsized returns while limiting downside risk. There are two main types of options: calls and puts. A call option gives you the right, but not the obligation, to buy a specific stock at a predetermined price, known as the strike price, on or before a certain date. A put option, on the other hand, gives you the right, but not the obligation, to sell a stock at a predetermined price on or before a certain date.
So with options, you're essentially betting on the future direction of a stock's price without actually owning the underlying shares.
That's a good way to put it. So let's say you're bullish on a particular stock and believe its price will rise. You could buy a call option with a strike price below the current market price. If the stock price goes up, the value of your call option will also increase, and you can either sell the option for a profit or exercise it to buy the stock at the lower strike price and then sell it at the higher market price. Now, if the stock price goes down, however, your maximum loss is limited to the premium you paid for the option.
It sounds like a way to amplify your gains while putting a cap on your potential losses.
Yeah, that's the key advantage of options. They offer leverage, meaning you can control a larger position with a smaller amount of capital. And because your risk is limited to the premium, you can potentially generate substantial returns with minimal upfront investment. Of course, like any investment strategy, options come with their own set of risks, and it's, crucial to understand how they work before diving in.
Now, you mentioned that options can be used in combination to create spreads. Can you elaborate on that?
Sure. Option spreads involve buying and selling different options contracts simultaneously to create a specific risk-reward profile. A common example is a vertical spread, where you buy an option with a certain strike price and sell another option of the same type, call or put, with a different strike price, both with the same expiration date. This strategy allows you to further manage your risk while still maintaining upside potential.
Could you give us a concrete example of how a vertical spread might work?
Let's say you're moderately bullish on a stock currently trading at, let's say, $50 per share. You could create a bull call spread by buying a call option with a strike price of $55 and selling a call option with a strike price of $60, both with the same expiration date. This strategy would limit your maximum profit if the stock price surged above $60, but it would also reduce your upfront costs compared to just buying a single call option with a strike price of $55.
So it's a way to fine-tune your risk-reward profile based on your market outlook.
That's right. Option spreads allow you to tailor your strategy to your specific expectations and risk tolerance. They provide a level of flexibility and control that can be highly beneficial in pursuing asymmetric returns.
That's fascinating. So options and option spreads are powerful tools in the asymmetric investor's toolkit. But what about those who prefer a more direct approach to stock investing?
For those who have high conviction in specific companies, concentrated equity positions can be another avenue for pursuing asymmetric returns. This strategy involves focusing your portfolio on a smaller number of stocks that you believe have exceptional growth potential. By concentrating your investments in a select few companies, you're essentially making a bigger bet on their future success.
But doesn't this approach kind of increase your risk? After all, you're putting more eggs in fewer baskets.
Yeah, it's true that concentrated equity positions come with higher risk. If one of your chosen stocks performs poorly, it will have a more significant impact on your overall portfolio. However, the potential rewards can be substantial if your picks turn out to be winners. The key to success with this strategy lies in thorough research, due diligence, and a deep understanding of the companies you're investing in.
So it's not just about picking a few random stocks and hoping for the best.
No, not at all. It requires a thoughtful and disciplined approach. You need to identify companies with strong fundamentals, a competitive edge in their respective markets, and a management team with a proven track record of success. And even then, it's essential to monitor your investments closely and be prepared to adjust your positions as needed.
I see. It's a high-risk, high-reward strategy that requires a certain level of expertise and commitment. Now, we've talked about options and concentrated equity positions as ways to potentially generate asymmetric returns, but what about protecting yourself from losses? What hedging techniques can investors use to safeguard their portfolios?
Hedging is a crucial aspect of asymmetric investing, especially when you're employing strategies that involve higher risk. One common hedging technique is the use of protective puts. A protective put is essentially an insurance policy for your stock holdings. By purchasing a put option on a stock you own, you're essentially guaranteeing yourself the right to sell that stock at a predetermined price, even if the market price drops significantly. This strategy can limit your downside risk while still allowing you to participate in any upward movements in the stock's price.
So it's like buying a safety net to catch you if the stock falls.
It's a good way to think about it. Protective puts can be particularly useful in volatile markets or when you're holding concentrated positions in stocks that could be susceptible to sudden price swings. They provide peace of mind and can help you sleep better at night knowing that your downside is protected.
Sounds like a valuable tool for managing risk. Are there other hedging techniques that investors should be aware of?
Absolutely. There are various other hedging strategies, including covered calls, collar options, and inverse ETFs, each with its own risk-reward profile and suitability for different market conditions and investment goals. The key is to choose a hedging strategy that aligns with your specific needs and risk tolerance.
It seems like risk management is like a constant theme in asymmetric investing. It's not just about chasing those big gains, it's also about protecting yourself from potential losses.
You're absolutely right. Risk management is paramount in any investment strategy, but it's particularly crucial in asymmetric investing, where the potential for both gains and losses can be amplified. One of the fundamental principles of risk management is diversification. By spreading your investments across different asset classes, sectors, and geographic regions, you're reducing the impact of any single investment's performance on your overall portfolio.
So even if one investment goes south, it won't sink the entire ship.
That's the idea. Diversification is a time-tested strategy for mitigating risk and smoothing out returns over the long term. It's, essential to remember that even the most well-researched investments can experience unexpected downturns, and diversification helps to cushion the blow of such events.
Sounds like a fundamental principle that all investors, regardless of their approach, should embrace.
I couldn't agree more. Diversification is not just a good idea, it's an essential part of any sound investment strategy.
Now let's talk about another crucial element of risk management, stop-loss orders. Can you explain how stop-loss orders work and why they're so important for asymmetric investors?
Yeah, so stop-loss orders are automated instructions that you place with your broker to sell a security if its price falls below a certain level. They're designed to limit your losses on a particular investment by automatically triggering a sale when the price reaches a predetermined threshold.
So it's like setting a safety net for each individual investment, ensuring that you won't lose more than a certain amount.
That's a good analogy. Stop-loss orders can be incredibly useful for managing risk, especially in volatile markets or when you're using strategies that involve higher leverage. They kind of take the emotion out of trading and help you avoid making impulsive decisions based on fear or panic.
So if a stock starts to tank, a stop-loss order will automatically sell it before it can fall too far.
Exactly. It's a way to protect yourself from catastrophic losses and preserve capital for future investment opportunities.
Sounds like a must-have tool for any investor, not just those pursuing asymmetric returns.
I would agree. Stop-loss orders are a fundamental risk management tool that can benefit investors of all levels of experience and risk tolerance.
Besides diversification and stop-loss orders, what other risk management practices should asymmetric investors be mindful of?
Another critical aspect of risk management is position sizing. Position sizing refers to the amount of capital you allocate to each individual investment in your portfolio. Determining the appropriate position size for each investment is essential for managing your overall risk exposure.
So it's not just about what you invest in, it's also about how much you invest in each position.
That's correct. Position sizing is all about balancing risk and reward. You don't want to over-allocate to any single investment, even if you have high conviction in its potential. Conversely, you don't want to under-allocate to an investment that could generate substantial returns.
It seems like finding the right balance is key. How do you determine the appropriate position size for each investment?
There are various factors to consider when determining position size, including your risk tolerance, your overall portfolio size, the volatility of the specific asset, and your conviction level in the investment thesis. There are also mathematical models and formulas that can help you calculate optimal position sizes based on your risk parameters and investment goals. However, regardless of the method you use, the key is to be disciplined and consistent in your approach.
So it's about having a systematic approach to allocating capital and not just relying on gut feeling.
Absolutely. Position sizing is a crucial aspect of risk management that should be approached with a data-driven and disciplined mindset.
Now, we've covered a lot of ground on risk management. Let's shift gears and talk about another intriguing aspect of asymmetric investing: market timing and tactical allocation. What do those terms mean?
Market timing refers to the practice of trying to predict the future direction of the market and adjust your portfolio accordingly. Tactical allocation, on the other hand, involves making strategic shifts in your asset allocation based on your outlook for different asset classes or sectors.
So with market timing, you're essentially trying to buy low and sell high. While with tactical allocation, you're making more nuanced adjustments based on your assessment of specific market segments.
That's a good distinction. Market timing is notoriously difficult to get right consistently. Predicting the short-term movements of the market is challenging, even for seasoned professionals. Tactical allocation, however, can be a more viable approach for investors who have a well-defined investment thesis and a solid understanding of market dynamics.
Can you give us an example of how tactical allocation might work in practice?
Let's say you believe that the technology sector is poised for strong growth in the coming year. You might decide to overweight your portfolio toward technology stocks, perhaps by allocating a larger percentage of your assets to a technology-focused ETF or mutual fund. Conversely, if you believe that the energy sector is facing headwinds, you might underweight your exposure to energy stocks.
So it's about making strategic bets on specific sectors or asset classes based on your market outlook.
That's right. Tactical allocation allows you to express your views on the market and potentially enhance your returns by overweighting sectors or asset classes you believe will outperform and underweighting those you expect to underperform.
Sounds like an active approach to portfolio management that requires ongoing monitoring and adjustment.
It certainly does. Tactical allocation is not a set-it-and-forget-it strategy. It involves continuous assessment of market conditions and a willingness to adjust your portfolio as needed to capitalize on emerging opportunities or mitigate potential risks.
So we've explored various strategies for pursuing asymmetric returns in the stock market, including options, concentrated equity positions, hedging techniques, and market timing and tactical allocation. But I'm curious, what about this concept of asymmetric alpha that we hear so much about in the investment world? What is it, and is it a realistic goal for investors to strive for?
Asymmetric alpha is often touted as the holy grail of active investment management. It refers to the pursuit of generating returns that significantly outweigh any potential losses, essentially aiming to beat the market by a wide margin while minimizing downside risk. It's an alluring concept that has captured the imagination of many investors.
Yeah, it sounds like the ultimate dream for any investor, achieving exceptional returns while minimizing the risk of losing money.
It certainly does. However, the reality is that achieving consistent asymmetric alpha is exceptionally challenging, even for the most skilled and experienced investment professionals. While the allure is undeniable, it's crucial to approach this concept with a healthy dose of skepticism and a realistic understanding of the obstacles involved.
Let's dive into those obstacles and explore why achieving consistent asymmetric alpha is such a formidable task.
One of the primary challenges in pursuing asymmetric alpha lies in the ever-changing nature of the market. Market conditions are constantly evolving, influenced by a myriad of factors such as interest rates, inflation, geopolitical events, technological advancements, and investor sentiment. What works in one market environment may not work in another, and strategies that generated exceptional returns in the past may not be as effective in the future.
So it's like trying to hit a moving target. The rules of the game are constantly changing.
That's a good analogy. The market is a dynamic and complex system, and predicting its future movements with any degree of certainty is a formidable task. Strategies that worked well during a bull market may backfire during a bear market, and vice versa. The constant flux of the market makes it extremely difficult to consistently identify and exploit opportunities that generate outsized returns while minimizing losses.
Sounds like adaptability and flexibility are like key traits for any investor seeking asymmetric alpha. They need to be able to adjust their strategies as market conditions change.
Absolutely. Rigidity can be a recipe for disaster in the investment world. Successful investors are those who can adapt to changing circumstances, recognize when their strategies are no longer working, and make necessary adjustments to stay ahead of the curve.
So the ever-changing nature of the market is one major obstacle to achieving consistent asymmetric alpha. What other challenges should investors be aware of?
Another significant challenge lies in the inherent limitations of active management. Active management, by its very nature, involves trying to outperform the market by selecting individual securities or making tactical asset allocation decisions. While this approach can potentially lead to higher returns, it also comes with higher costs and greater complexity.
So with active management, you're essentially paying for the expertise and effort of a professional manager to try and beat the market.
That's the basic premise. Active managers charge fees for their services, and these fees can eat into your returns, making it harder to achieve that coveted outperformance. Moreover, the complexity of active management requires significant time, effort, and expertise to monitor and manage your investments effectively.
It sounds like active management can be a double-edged sword. While it offers the potential for higher returns, it also comes with higher costs and greater demands on your time and attention.
That's a fair assessment. Active management can be a viable approach for some investors, but it's not a guaranteed path to success. It's essential to carefully consider the costs, complexity, and potential risks before embarking on this path.
So the ever-changing nature of the market and the inherent limitations of active management are two major hurdles to achieving consistent asymmetric alpha. Are there other challenges we should be aware of?
So yeah, there are a few more challenges to achieving consistent asymmetric alpha. Another significant obstacle lies in the realm of behavioral finance. Behavioral finance is a field of study that explores how psychological factors influence investment decisions. It recognizes that investors are not always rational actors, and that emotions, biases, and cognitive errors can lead to suboptimal investment outcomes.
Ah, those pesky biases. I'm guessing they can affect even the most seasoned investment professionals.
Even the most experienced and sophisticated investors are susceptible to behavioral biases. These biases can cloud judgment, distort perceptions of risk and reward, and lead to impulsive or irrational decisions.
Can you give us some examples of common behavioral biases that can hinder the pursuit of asymmetric alpha?
One common bias is overconfidence. Overconfidence can lead investors to overestimate their abilities and take on more risk than they can handle. It can also make them less likely to adjust their strategies when they're not working.
So overconfidence can make investors blind to their own limitations and less willing to admit when they're wrong.
That's right. Another common bias is confirmation bias. Confirmation bias is the tendency to seek out information that confirms our existing beliefs and to ignore or downplay information that contradicts them.
So if we believe a particular stock is a good investment, we might be more likely to focus on positive news about the company and ignore any negative reports.
That's a classic example of confirmation bias at work. This bias can prevent investors from objectively assessing the true risks and rewards of an investment and can lead to poor decision-making.
It sounds like behavioral biases can be insidious, subtly influencing our decisions without us even realizing it.
That's the danger of these biases. They often operate beneath the surface of our conscious awareness, making it difficult to identify and counteract them.
So how can investors mitigate the negative effects of behavioral biases on their investment decisions?
One effective strategy is to develop a systematic and disciplined investment process. By following a predefined set of rules and procedures, investors can reduce the influence of emotions and biases on their decision-making.
So it's about taking a more data-driven and less impulsive approach to investing.
That's the idea. Another helpful strategy is to seek out objective advice from a trusted financial advisor. A good advisor can provide an unbiased perspective, challenge your assumptions, and help you make more rational investment decisions.
It sounds like having a sounding board and a voice of reason can be invaluable in mitigating the impact of behavioral biases.
It can make a world of difference. The key is to find an advisor who is truly objective and has your best interests at heart.
So the ever-changing nature of the market, the inherent limitations of active management, and the pervasive influence of behavioral biases are all formidable challenges to achieving consistent asymmetric alpha. Are there any other obstacles we should be mindful of?
Yes. Another significant challenge lies in the realm of market efficiency. Market efficiency refers to the degree to which market prices reflect all available information. In a perfectly efficient market, prices would instantly adjust to reflect any new information, making it impossible to consistently outperform the market by identifying undervalued or overvalued securities.
So if the market is truly efficient, everyone has access to the same information, and there are no easy opportunities for arbitrage or exploiting inefficiencies.
That's the basic idea. While real-world markets are not perfectly efficient, they're generally quite efficient, especially in well-developed and liquid markets like the U.S. stock market. This efficiency makes it increasingly difficult for investors to consistently find mispriced assets and generate alpha.
It sounds like market efficiency is a formidable opponent for any investor seeking to beat the market.
It's certainly a factor to consider. The more efficient the market, the harder it is to consistently generate outsized returns.
So the ever-changing nature of the market, the inherent limitations of active management, the pervasive influence of behavioral biases, and the challenge of market efficiency are all major obstacles to achieving consistent asymmetric alpha. Are there any other challenges we should be aware of?
Yes, there's one more significant challenge I'd like to highlight, and that's the issue of survivorship bias. Survivorship bias refers to the tendency to focus on the successes while overlooking the failures. In the context of investment management, survivorship bias can distort our perceptions of the likelihood of success in active management.
Can you elaborate on that? How does survivorship bias affect our understanding of active management?
When we look at historical data on, say, mutual fund or hedge fund performance, we often only see the track records of funds that have survived and are still in operation. The funds that performed poorly and closed down are often excluded from these databases, creating a skewed picture of the industry's overall performance.
So the data we see might be painting a rosier picture of active management than reality.
That's a possibility. Survivorship bias can lead us to overestimate the average returns of active managers and underestimate the risk of failure.
It sounds like survivorship bias can create a false sense of confidence in the ability of active managers to consistently outperform the market.
It's definitely something to be aware of. When evaluating the track records of active managers, it's essential to consider the potential impact of survivorship bias and to look beyond the headline numbers.
So we've explored 5 major challenges to achieving consistent asymmetric alpha. The ever-changing nature of the market, the inherent limitations of active management, the pervasive influence of behavioral biases, the challenge of market efficiency, and the distorting effects of survivorship bias. Given these formidable obstacles, is it even realistic for investors to strive for asymmetric alpha?
That's a great question, and it's one that has no easy answer. While achieving consistent asymmetric alpha is undoubtedly challenging, it's not impossible. There are skilled and experienced investors who have demonstrated an ability to generate outsized returns while managing risk effectively. However, it's important to approach this pursuit with a realistic understanding of the challenges involved and to recognize that it's not a guaranteed path to success.
It sounds like achieving consistent asymmetric alpha is a bit like climbing Mount Everest. It's a formidable challenge that requires exceptional skill, preparation, and a bit of luck along the way.
That's a great analogy. It's an ambitious goal that should not be undertaken lightly. However, for those who are willing to put in the effort, develop their skills, and embrace a disciplined and adaptable approach, the pursuit of asymmetric alpha can be a rewarding journey.
So we've explored the strategies, the potential pitfalls, and the inherent difficulties of consistently achieving asymmetric alpha. But I'm curious, what does history tell us about all of this? What lessons can we learn from how different investment styles have performed over time? What insights can we glean from the annals of financial history to guide us in our quest for asymmetric returns?
By examining the historical performance of different investment styles, we can gain valuable insights into what has worked, what hasn't, and what lessons we can apply to our own investment decisions. So let's take a trip down memory lane and explore the history of investment styles to see what wisdom it holds for us as we continue our deep dive into asymmetric investing.
We've explored the allure and the potential pitfalls of asymmetric investing and the concept of asymmetric alpha. Now let's take a trip down memory lane and see what insights we can glean from the history of different investment styles.
History offers valuable insights into the cyclical nature of markets and investment strategies. It can teach us not only about what has worked in the past, but also about the importance of adapting to changing market conditions.
Let's start with the classic battle between value and growth investing. It's a debate as old as the market itself. What can history tell us about these two approaches?
The historical data reveals a fascinating interplay between value and growth investing. Value investing, which focuses on buying undervalued companies with strong fundamentals, has generally outperformed growth investing over long periods. However, there have been periods, sometimes extended periods, where growth stocks, representing companies with high earnings growth potential, have taken the lead. For instance, the tech boom of the late 1990s and early 2000s saw growth stocks soaring to unprecedented heights, while value stocks lagged behind.
So it's not a matter of one style being inherently superior to the other, but rather recognizing that their performance tends to be cyclical.
That's a key takeaway from market history. Value and growth investing go through cycles of outperformance and underperformance. Sometimes value is in favor, sometimes growth is in favor. Savvy investors recognize these cycles and adapt their strategies accordingly.
It seems like flexibility and adaptability are like essential traits for successful investors. Now let's move on to another classic debate. Small cap versus large cap stocks. What insights does history offer on this front?
Small-cap stocks, representing smaller companies with higher growth potential, have historically delivered higher returns compared to large-cap stocks, which represent more established and stable companies. However, this higher return potential comes with higher volatility and risk. Small-cap stocks tend to be more susceptible to market swings and economic downturns.
So it's the classic risk-reward trade-off. Higher risk, higher potential reward.
That's a fundamental principle in investing. Small-cap stocks, with their higher growth potential, can offer attractive returns for investors with a higher risk tolerance and a longer investment horizon.
Now let's shift our focus to a debate that has been raging for decades. Active versus passive management. What does history tell us about the effectiveness of these two approaches?
The historical data on active versus passive management paints a somewhat nuanced picture. While there are certainly skilled active managers who have consistently outperformed their benchmarks, the data shows that a significant portion of actively managed funds actually underperform their passive counterparts, especially after fees and expenses are taken into account.
So the odds of finding that, like star manager who can consistently beat the market, are slim.
It's not an easy task. Passive management through low-cost index funds or ETFs has gained significant popularity in recent years, as it offers a simple and efficient way to track the performance of a particular market or index. For many investors, passive management provides a cost-effective and less time-consuming approach to investing.
Seems like the choice between active and passive management depends on individual investor preferences, risk tolerance, and investment goals.
That's a good point. There's no one-size-fits-all answer. Both active and passive management have their pros and cons, and the best approach for you will depend on your specific circumstances and investment philosophy.
Now we've discussed the cyclical nature of value and growth investing, the risk-reward trade-off with small-cap stocks, and the ongoing debate between active and passive management. But how do these historical lessons connect back to the concept of asymmetric investing?
Asymmetric investing at its core is about tilting the odds in your favor, seeking out opportunities where the potential rewards outweigh the risks. Understanding the historical performance of different investment styles can provide valuable insights into where those opportunities might lie.
Can you give us specific examples of how historical insights can inform asymmetric investing strategies?
Certainly. For instance, recognizing the cyclical nature of value and growth investing can help asymmetric investors identify periods when value stocks might be undervalued and poised for a potential rebound. Similarly, understanding the historical outperformance of small-cap stocks while acknowledging their higher volatility can guide investors in allocating a portion of their portfolio to this asset class, seeking to capture those higher potential returns while managing the associated risks.
So it's about using historical data to inform your investment decisions and identify potential opportunities for asymmetric returns.
That's a key aspect of asymmetric investing. History doesn't repeat itself, but it often rhymes. By studying past market cycles and the performance of different investment styles, we can gain valuable insights into potential future trends and adjust our strategies accordingly.
It sounds like history can be a valuable guide, but it's not like a crystal ball.
Yeah.
You still need to apply critical thinking and adapt your strategies based on current market conditions.
You're absolutely right. Historical data can inform our decisions, but it's not a guarantee of future success. The market is constantly evolving, and we need to be flexible and adaptable to thrive in this dynamic environment.
Okay, so we've explored these historical lessons about the cyclical nature of value and growth, the risk-reward trade-off with small-cap stocks, the challenges of active management, and the enduring relevance of these insights for asymmetric investors. But what does all of this mean for someone listening to this, someone who wants to make smarter investment decisions in today's world? What are the key takeaways we can glean from this historical journey to guide us on our path to asymmetric returns?
I think there are several key takeaways for investors seeking to apply the principles of asymmetric investing in today's market. First and foremost, diversification remains crucial. Given the cyclical nature of investment styles and the inherent uncertainty of the market, a well-diversified portfolio helps to smooth returns and reduce the risk of being overexposed to any single approach that might be underperforming at a given time.
So don't put all your eggs in one basket, as the saying goes.
Sound advice indeed. Spreading your investments across different asset classes, sectors, and geographic regions can help to mitigate risk and enhance long-term returns.
That makes sense. Now, what about the cost of investing? We've talked about the fees associated with active management. How should investors approach this aspect, especially in the context of asymmetric investing?
Cost awareness is paramount in investing, especially when pursuing asymmetric returns. High fees can eat into your profits, making it harder to achieve your investment goals. Passive investing through low-cost index funds or ETFs can be an attractive option for many investors, providing a cost-effective way to gain exposure to a broad market or a specific sector. However, if you choose to pursue active management, be selective. Choose managers with a proven track record, a transparent investment process, and fee structures that align with their performance incentives.
So do your homework before entrusting your money to an active manager. Don't just blindly follow the crowd or chase the latest hot investment trend.
Absolutely. Due diligence is essential in any investment decision. Take the time to understand the manager's investment philosophy, their risk management practices, and how their fees align with their performance goals.
Now, we've talked about diversification and cost awareness as key considerations for asymmetric investors. What about the importance of having a long-term perspective?
Patience is a virtue in investing, particularly when pursuing asymmetric returns. Short-term market fluctuations can be distracting and emotionally draining. It's crucial to maintain a long-term perspective and focus on your overall investment goals. Remember that asymmetric investing is not about getting rich quick. It's about strategically positioning yourself for potential outsized gains over time while managing the inevitable ups and downs of the market.
So tune out the noise, stay focused on your goals, and don't let short-term market gyrations derail your long-term investment plan.
Wise words. The market is a marathon, not a sprint. Patience and discipline are essential traits for success in the long run.
Now let's talk about adaptability. We've discussed the importance of being flexible and adjusting your strategies as market conditions change. How can investors stay ahead of the curve and make necessary adjustments without getting caught up in the emotional swings of the market?
One effective strategy is to develop a systematic and disciplined investment process that includes predefined triggers for making adjustments to your portfolio. For example, you might establish specific criteria for rebalancing your portfolio, such as when the allocation to a particular asset class deviates significantly from your target allocation. This approach can help to reduce the influence of emotions and ensure that you're making adjustments based on a predetermined plan rather than reacting impulsively to market movements.
So it's about having a clear set of rules and guidelines to guide your investment decisions rather than relying on gut feeling or emotional reactions.
That's right. A systematic approach can help you stay disciplined, avoid costly mistakes, and make more rational decisions even during turbulent market conditions.
Now let's address one final but crucial element of successful investing. Self-awareness. We've discussed the pervasive influence of behavioral biases on investment decisions. How can investors mitigate the negative effects of these biases and make more rational choices?
Self-awareness is key. Recognize that we all have biases, and these biases can cloud our judgment and lead to suboptimal decisions. One effective strategy is to seek out objective feedback from trusted sources, such as a financial advisor or a mentor. They can provide an unbiased perspective and help you identify potential blind spots in your thinking. Another helpful approach is to keep a journal of your investment decisions, documenting your rationale for each trade. This practice can help you identify patterns in your behavior and recognize potential biases that might be influencing your choices.
It sounds like self-reflection and a willingness to seek out external feedback are essential for mitigating the impact of behavioral biases.
They're invaluable tools for improving your decision-making and enhancing your investment outcomes. Remember, investing is as much a psychological game as it is a financial one. Understanding your own biases and developing strategies to counteract them can make a significant difference in your long-term success.
I think we've covered an incredible amount of ground in this deep dive into asymmetric investing. We've explored the core principles, the strategies, the potential pitfalls, and the historical lessons that can guide us on this path. As we wrap up this deep dive, I want to leave our listeners with a final thought-provoking question. As you think about your own investment goals and aspirations, how might you apply the principles of asymmetric investing to enhance your portfolio and potentially achieve those outsized returns we've been discussing? Are there areas where you might be taking on more risk than necessary or missing opportunities for greater potential upside? It's a question worth pondering as you continue your investment journey.
Indeed. Continuous learning, adaptation, and self-reflection are essential for success in the ever-evolving world of investing. By embracing the principles of asymmetric investing, understanding your own biases, and maintaining a disciplined and adaptable approach, you can position yourself to potentially achieve your financial goals and navigate the complexities of the market with greater confidence and clarity.
Thanks for joining us on this deep dive into asymmetric investing. I hope you found this exploration informative and insightful. Till next time, happy investing.